Hi, everyone. This is Jason Merrick of Wall Street from Main Street.
And this is Lee Justa from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 16. So, Lee, we wanted to talk about, we didn't get to mention on the last show, which was a special with Trader Aaron from Carnivore Trades, and who also does This Week in Charts. We didn't get a chance to talk about some of the craziness that the central banks are doing. The Bank of Japan, it seems that their policies are finally starting to fail. And then we had this news story recently that just came out with the Swiss National Bank, apparently the world's largest hedge fund, and having like larger than long-term capital management type losses here with their hedge fund trades.
You know, you should talk a little bit about how they got to become the hedge fund they did, because it's a little interesting background that we were talking about before the show.
Yeah, and actually, most of the news stories that come out about the Swiss National Bank losses, they intentionally leave this out because this would make people question governments' power and central banks' power and fiat currencies. So the Swiss National Bank, in only a 3-year period, it was about 3 years, give or take, from, I believe, 2013 to around 2016. So this was before Brexit. This was while the European Central Bank was bailing out Deutsche Bank, and they were dealing with Greece and Goldman Sachs and the pigs crisis, which is Portugal, Italy, Ireland, Spain, and Greece. And then you had this was a little bit prior to Brexit, and then you had the separate problems with Greece and MF Global and all the derivatives and all that stuff tied to them. The European Central Bank was doing, on a percentage basis, way more balance sheet expansion or quantitative easing than the Federal Reserve Bank. And so they were buying up, they were printing insane amounts of euros. They were expanding their balance sheet. They were buying corporate bonds. They were buying government bonds. They were buying almost any bonds that they could. Interest rates in Europe went negative. So a lot of capital flight, because people in the European Central Bank, if you had a lot of cash in your bank account, you were getting charged by the banks to keep it there. So they were charging you because of negative interest rates. They were penalizing you for saving. And so a lot of people started moving their cash into like either Cyprus temporarily. They moved it into Cyprus, and that was a bust and a failure. And then a lot of people moved it into Switzerland. And so the Swiss National Bank, to counter this, and I'm using air quotes because it was dumb policy, they ran a euro peg to try to stabilize their exchange rate, the Swiss francs exchange rate against the euro. So they created a euro peg with a exchange rate that the PhD economists at the Swiss National Bank decided on, and they ended up creating out of thin air around and this is what they said. We don't know the real number. This is what the Swiss National Bank disclosed. They created $300 billion worth of currency in about 3 years running the euro peg. At the end of it, they said it was a failure. What was left, the aftermath, though, the effect was they took this currency, and it wasn't just going to sit there in a bank account earning zero or negative rates or wherever they were going to put the cash. They put the cash to work that they created out of thin air, this fiat currency, and they started buying U.S. tech stocks and other stocks. So the Swiss National Bank, in a short amount of time, became an enormous hedge fund, arguably the world's largest hedge fund.
And now they're looking at a 116-year biggest loss of $143 billion.
And you said that was just on foreign currency transactions. Now, I saw someone post that they have millions of shares of Tesla Motors and that they wrote it all the way down. So they haven't.
Yeah, I had read that it was 140 billion of that came from foreign currencies. So if they're in tech stocks and they're hitting, you mentioned Tesla as a big position of theirs.
I believe it was one of their largest holdings. Yeah. But at one point, though, what's funny is at one point, I think this was years ago, the Swiss National Bank owns 40 or 50% of all the Facebook shares. That's how insanely large the Swiss. Yeah, they sold it at a profit because Facebook ran up. They sold it at a profit. They were doing all these crazy hedge fund trades. This is a central bank.
Wow, and it's basically sovereign wealth, right? I mean.
That with currency created out of thin air. So I've spoken off the record with other Wall Street people, and this type of stuff has happened in Norway and other central banks.
Well, this kind of harkens back to the Creature Jekyll Island. I mean, that's basically what his argument was, and we're seeing it play out.
Well, and this is my thesis too, that the governments and central banks just have too much power and control over our lives, over the economy. They bail out their friends or family members. We were discussing this before we started recording. The people in power didn't learn any valuable lessons from Lehman Brothers. So they actually said the mistake with Lehman Brothers was letting a bank go bankrupt.
That's unbelievable. Really. Now the one The one shining investment of the Swiss National Bank was actually gold, where they had a $4.5 billion profit, which I think is hysterical.
Not surprising. I mean, we've been on these shows and in my interviews with experts, and I've been telling people publicly. I even did a private conference call with George Gammon's Rebel Capitalist Pro people over the summer. I was predicting, I think, 2,500 gold in under 3 years. I was saying gold was bottoming. This was before we saw the news story come out about record amounts of central bank buying of physical gold tonnage in the third quarter, the most since 1967. I mean, the newest story that we're seeing a lot of sales from the mints, and then also Russian physical gold demand. I think their tonnage purchases are up enormously because they've had so much currency instability. It's not surprisingly because with higher interest rates, if you learn from financial history, a lot of companies in a lot of sectors go bankrupt. And gold, physical gold, has very little counterparty risk compared to companies and sectors when central banks they're claiming at least that they're reducing their balance sheet and they're raising interest rates. So we haven't had the full effect of the higher interest rates go throughout the entire economy yet. We've had asset prices obviously have volatility, and some asset prices are down at enormous lows, but we haven't had the wide scale bankruptcies yet of a recession or depression from higher interest rates. So if we learn from financial history, with higher interest rates, this often creates a lot of companies in different sectors going bankrupt, and that should be good for gold as people look to either go to cash, go to US Treasuries, and go to gold. Those are historically the three most typical safe havens in these types of environments.
Well, while we're still on central banks, let's talk a little bit about Japan and their experiment in yield curve control.
I mean, they've been doing this for so long, for over 30 years. They were the only country that was able to get away with this for so long throughout financial history, really. There are a lot of reasons why they're able to get away with it. They were exporting a lot of it in the yen carry trade. There was a lot of Japanese people that were sacrificing their savings to buy Japanese government bonds. And finally, they've hit the wall. I think a lot of it, Lee, had to do with the fact that they weren't running trade surpluses anymore. So that was a big part of it. And then higher energy prices because they had to import so much more oil, coal, natural gas, liquefied natural gas. They haven't restarted their nuclear power plants yet. They've been talking about it. I don't think they fully restarted them, but they're manufacturing powerhouse. And if we do have a prolonged recession or depression, the consumer in the United States and other countries is not going to be spending as much of their discretionary income on high-end Japanese electronic goods. So they're not going to be able, their manufacturing powerhouses, while they still need cheap electricity, they're not going to be running the trade surpluses that they anticipated. So I think you have a combination of strong dollar, higher interest rates, less consumer spending, much higher energy prices, all these factors. And that's created a scenario where the tide has gone out. And now we find out who's swimming naked, to use the old Warren Buffett quote that we've talked about.
Well, you know, the Bank of Japan, they doubled the yield ceiling on the 10-year yield back in December. And it was a bit of a shock to the market. They've got a meeting this Wednesday. I don't think they're going to really do much because I don't think they want to go back and appear that was a wrong decision. But what is interesting is Kuroda, who's the governor there, he's stepping down in April. So it'll be interesting what happens post-April. I mean, I know that's a way off, but
well, if you go back, Lee, though, sorry to interrupt you. If you go back through the old quotes, so from the Bank of Japan over the last 6, 7, 8, 10 years, I mean, they were begging for higher inflation. Go back and look. People have such short-term memories nowadays. Everything's so short-term and myopic. Go back and look at the old interviews that Janet Yellen was saying from 2013 to 2019. She was saying inflation was too low here in the United States. And now look what we have. I mean, the deflationistas are saying inflation is done, but here in reality, here in the real world, I go out to eat with my best friend once or twice a week, and then the menu prices are still going up at restaurants, and there's still shrinkflation and stagflation. A lot of the software companies that I need to run my business and stuff like that, the software programs I have are raising prices still. The consumer price index or CPI or changing propaganda index is not accounting for any of this. So the narrative is that inflation has peaked. We're just not seeing it. But yeah, Japan was saying for years, Lee, that inflation was too low. We need more inflation. Now they've gotten it, and it's not working out the way they anticipated.
No, of course not. You know, one component of it, I mean, we tend to think of inflation in terms of monetary policy and everything else, but one significant factor has been just the supply chain and I mean, and the cost of fertilizer, the Ukraine war. I mean, it's really just a giant mess out there.
Oh, and yeah, I totally agree. Look at eggs. The newest one's eggs.
Yeah. Oh, and
everyone's talking about everyone's talking about eggs now. The wholesale cost of eggs. There's clearly a supply chain problem there.
And we were talking a little bit before about the Strategic Petroleum Reserve and how it was sold off, and that was a bit of a dampen on the inflation, but I think that's now at an end. That led to a conversation about the natural gas in China. So why don't we touch on that now?
Well, the consumer price index doesn't accurately account for energy prices anyway. I mean,
no, it doesn't account for anything really. It's all I think manufactured nonsense.
Energy accounts for so much besides the cost of capital. So interest rates for a lot of funding for companies, energy prices. So diesel, electricity, gasoline.
The whole economy runs on it.
Yeah. So if you have much higher diesel prices, electricity prices, gasoline prices, just energy costs in general, I mean, you're looking at higher floors for prices. And the consumer price index, and I got it. I brought up, remember on the last show, I brought up a hedge fund manager that had a weird trade on where he's short inflation and he's starting to build a very long position in oil, which didn't make a lot of sense. I actually spoke to the hedge fund manager on Twitter about this. And he said it's because of the way the changing propaganda index is measured, it's base effects. So what this base effects does is if the inflation rate is not increasing in the prices that these PhD economists at the Bureau of Labor Statistics and the Fed are measuring, if the price increases are not increasing at a higher rate, the base effects basically covers all this. It's what in non-technical terms, so easier to understand terms, it's a deflator. So the base effects naturally deflate the inflation statistics. So if the prices are not increasing, say 7% per year over year, so another 7%, the base effects will catch up to the price increases and say, even though if you're running a business or you're a consumer and you're dealing with shrinkflation, you're dealing with higher prices, your cost per unit's getting killed as a consumer or a business owner, the base effects will say that doesn't matter because the year over year change in prices is not happening at the faster rate there, and that's a deflator. So even though the cost structure,
right,
even though you're getting less goods and services for more dollars or euros or whatever fiat currency, even though you're getting less for more currency, so your standard of living is being destroyed, your profit margins at your business are being destroyed, the base effect says that doesn't matter. The rate of change of the increase in prices has slowed, and therefore that's deflation. Even though it's a higher price floor and your cost, you go shopping at the grocery store and your cost per unit, so you're paying like an insane higher cost for that. The deflator.
Boy, this sounds an awful lot like hedonic adjustment of inflation.
That's a fancy term. That's a fancy term, Lee. It's a deflator to hide the inflation. So right. Go back for my listeners who want to hear that governments have been doing this for forever. Go back and listen in the archives to my interview with Yuri Maltsev. He defected from the Soviet Union. He was a very higher up in the Soviet Union economic department. He works for the Mises Institute, and he's spoken many times in long speeches. He defected there, and he was talking about how the Soviet Union for decades had 3 sets of accounting books, and there was top secret security clearance levels, and they never told the truth to the public or even to their own citizens about how the economy was really doing. So there was 3 sets of accounting books. There was total accounting fraud, and the PhD economists were in charge of that. So that's basically what the PhD economists at the Bureau of Labor Statistics and at the Federal Reserve banks are in charge of doing.
They're following the same model that the Soviet Union basically did. Hey, before we get off the whole central bank thing, I just want to mention that I did recently put out an interview I had with John Titus on my channel. I highly recommend everyone watch it. John is just great talking about the Fed.
Yeah, John's a lawyer, so he understands. I've watched his videos in the past from economics and finance. That's not his specialty, so he's going and looking through the laws.
Exactly, yeah. But it was a great discussion. So now let's talk a little bit about the CPI lie that just came out with the December report. Now, according to Fun stats, Tom Lee, he said that 59% of the components are now in deflation mode. Do you think that's a realistic assessment of what's going on, or do you think it just ties into, the CPI?
I think there's a new normal, higher cost pressure. I mean, natural gas prices have gotten collapsed by 50%. And you wanted to bring that up earlier, so you could bring that up now. So you have natural gas futures contracts are down, but I mean, are the utility companies really going to cut prices by 50%? So I don't think this is going to permeate, especially in a lot of other countries like emerging markets where labor costs are starting to skyrocket now. You have a lot of unions, a lot of employees that are demanding higher wages. They want to offset or at least partially offset the inflation that has already occurred. So that's creating higher cost structures for businesses. The consumer is going to have to pay for it. If you're a business owner and your costs are up and your profit margins are getting squeezed, you're going to have to pass these higher costs on to your customer. You're not an evil, greedy capitalist profiteering like the politicians and the bureaucrats and the socialists and the Marxists are saying. You either have a profit margin or you don't have a business. Well, unless you were a Silicon Valley company for many, many years that was easily able to keep selling more and more equity, more and more shares on a revenue only business model and able to create your own accounting metrics. But even those days, at least for now, seem to be over.
Windfall profits, tax aside, right?
I don't think they're going to go after everyone for windfall profits taxes. I mean,
certainly not going after Washington insiders.
Well, I mean, the narrative I've seen was that the oil and energy companies for a while, but now that gasoline prices are down, natural gas prices are down, it's calmed down a little bit. So we'll see what the politicians decide to do. But if they put that windfall profits tax on now, I mean, we're looking at severe energy problems. We were talking about this before we start recording. In the hedge fund community, there's very little percentage of hedge fund managers now that are neutral on the oil price. So neutral on oil and energy prices, the conventional energy. So oil, natural gas, coal, things like that. It's very polarizing the way a lot of professional money managers are with energy prices. There's very little people. And by neutral, I mean, they think the price is going to stay in a trading range around 70, $80, maybe 85 or 90, somewhere in that trading range, kind of a Goldilocks oil price. The community either seems to think that there will be really bad recession, depression, and energy prices will collapse. There's a large percentage of that. And you see that with the amount of people that are short on the futures market, short oil futures contracts and natural gas, obviously. And then there's a lot of people, and even Kyle Bass recently, and I was pretty surprised because he's publicly endorsed more environmental policy stuff, even though he's a libertarian. And he said the value proposition for a lot of these oil and gas plays. So that's kind of like the disparity there between the people that are short and the people that are building long positions. And there's very little people in between for professional money managers in the energy space.
Well, from a technical standpoint on the oil charts, I mean, they did trace out basically a large head and shoulders top over the past year or so, which typically means, I mean, it broke the neckline. It's like up at the point where it's testing it now. That would suggest further move down in oil if you're just looking at it from a purely technical standpoint.
I mean, it depends if the Strategic Petroleum Reserve towards the end of the year, if they start buying back more oil, or if OPEC announces further production cuts. So there's other factors, or Russia has even said over the last 6 to 8 months that they could cut production. So we'll see what happens. I mean, if there's a lot of supply that comes offline, I mean, that's going to put a bottom in faster in oil and natural gas.
Yeah, or if the economy completely collapses, that could also put a damper on it. So,
well, we could see a replay then similar. I don't think oil futures contracts will go negative, but we could see a replay then, Lee, similar to 2020 and 2021, where we have a V shape where the oil or natural gas price futures contract have already collapsed in the last 2 months, down over 50%. I think they're around 3.6 right now when we're recording the show on Sunday night, January 15th, 2023. But we could see that where energy prices temporarily collapse for a couple quarters. And then by the end of the year, we have another big rally set up for end of 2023, 2024. You wanted me to talk about natural gas, though. So Let me just lay out, because I've had conversations with retired Chinese investment bankers about the policies that some of the commodities trading houses that are pretty large in China do. And the oilprice.com also had this article out in the first week of October talking about how China had resold an enormous amount of their natural gas, their liquefied natural gas tankers to Europe to the European Union because they had such an energy shortage at sky high prices. So this was back in September, probably August, September, and early October, when natural gas prices were still 7 or 8 for the regular, and LNG prices in Europe were still sky high. So the Chinese have been stockpiling because they have an energy shortage too, but they also trade to a lot of these commodity markets very actively through their commodities trading houses, either that are set up through their investment banks, some type of it's a separate vehicles from speaking with Chinese investment banker. But they sold, my educated guess is they sold a lot of their extra natural gas at the sky high price. And then they started to go short natural gas futures immediately after, because they know they were going to sell a lot of it. And they went short natural gas futures. And then you started to see the reports come out about, the weather reports, the weather is not as cold as anticipated for the winter in Europe. So that's bearish for natural gas. But the natural gas price action just on a weather report, I mean, it was a much larger reaction just on a weather report compared to the past. But a lot of hedge fund managers have piled on, especially when you see all these news stories that are bad, that look like recession or depression. That normally means, at least in the short term, less energy demand, but you still have more supply problems coming. So I suspect what is happening now that China offloaded a ton of their liquefied natural gas to Europe at sky high prices. And I suspect they went short and profited there. They're covering their shorts now, and they still need the natural gas. So they're going to build a position and accumulate at certain levels. And the natural gas price is probably going to bottom, and they're going to accumulate and start taking delivery of that natural gas and setting up tankers. And they're going to move because they still need the supply. So I'm not predicting a big natural gas rally in the short term, but I suspect that that's the type of trade that the Chinese set up, that they offloaded a ton of their natural gas to Europe at the sky high prices. They went short, and now they're rebuilding their actual physical position in the futures market.
So do you think now is a good opportunity to start looking at natural gas companies to invest in?
For sure, but I'm not immediately looking at going out and buying stuff. So there's a lot of good opportunities, I suspect, over the next 2, 3, 4 quarters. I don't know about 4 quarters, but 2 or 3 quarters. And here in the United States and Canada, there's actually a lot of natural gas producers that now at the futures contract price for natural gas here in the United States is actually below the cost of production. So historically, that means that the price, it may go a little bit lower in the short term, but we're not in an environment now, Lee, where the natural gas producers can produce, and they weren't making a profit 3, 4, 5, 6 years ago at 2 or 3 anyway. That was being subsidized by pension funds. So when natural gas prices, and everyone was short natural gas, and there was a hedge fund for years that just sold calls. And they were shorting natural gas, and they made a ton of profits. But then when natural gas had a big rally, the hedge fund blew up.
Of course, yeah.
But that natural gas was never profitable for many, many years. The shale byproduct, the shale gas, was never profitable. So there was a ton of supply. It was flared off. We didn't have proper storage areas. And the $2 or $3 natural gas, I mean, the drilling costs now over the last 2.5 years are up a lot. So there's very few oil producers. I mean, the Saudis are not producing at $10 or $20 a barrel anymore at a profit. The majority of their oil production, they're bringing on a lot of deep water offshore wells. I've had oil hedge fund manager Josh Young on to talk about this, and he monitors Saudi Aramco. So they've brought on a lot of their oil production to replace Gawar is the $30, $40, $50 a barrel range. And that's the lowest cost, one of the lowest cost producers in the world. So they've replaced a lot of their formerly super low cost stuff with higher cost. They're still, on a relative basis, they're still lower cost than a lot of other oil producers, but their costs are not $10 or $20 a barrel anymore. That's my point. It's, for a lot of oil producers, you're looking at between $40 and $60 a barrel for production costs.
That's a significant bump up. That's a significant bump up from $20.
Yes,
Oh,
exactly. Exactly.
yeah.
And for natural gas, and this is before the oil service companies raise their prices, because the oil service companies, so Schlumberger and
Right.
Halliburton and those
Yep.
guys, they cut prices enormously in 2019 and 2020 and part of 2021 to get anyone to do any drilling. So they had to slash prices. They were running at losses just to get any business for about 2.5, 3 years. So by 2022, you had a situation for a good chunk of the year, about half the year. And Schlumberger in the second quarter of 2022, they were cash flow negative because they said that they had to raise prices. So drilling costs are going to go up. If the service companies raise prices, drilling costs are going to go up. That means higher price floors. Hedge fund manager, the hedge fund manager that has a lot of long oil trades, Harris Kupperman, aka Cuppy, he's talked about this. In the energy space, you're looking at much higher cost structures for a uranium miner, much higher cost structure for natural gas companies, much higher cost structure for liquefied natural gas for that business, and then much higher cost structure for oil production. So all that cheap oil that was available 10, 15, 20 years ago, it's the new normal is a lot higher cost than compared to the past, especially with all this extra inflation that's been put in. And then you have a lot of the oil service workers that were in Schlumberger and Halliburton here in the shale patch here in the United States. They left to go into construction in home building. So they will eventually probably be switching out of home building now, Lee, because I don't anticipate that there's going to be a housing bull market going forward. Well, unless the Fed cuts interest rates again. I mean, if mortgages are going to stay at these levels, I don't anticipate a housing bull market continuing here in the United States.
Well, if you have an adjustable rate mortgage past year, you've been getting killed. So there's actually an article on Zero Hedge now, and they're talking about Goldman analysts, and they're expecting a sharp contraction in profit margins for companies, and part of that is cost structure. So it's not just oil and gas. I mean, it's going to be across the board that costs are going up for everyone.
Oh, yeah, but especially for a commodity, though, because a lot of these commodity companies, especially with natural gas producers, they had hedges on. So I interviewed hedge fund manager Kevin Duffy from Bearing Asset Management. I think it was back in February or March of 2022. It was, I think, before the summer. So it was in spring of 2022. And you can go back in the archives and look that up. And he was talking about natural gas companies and the hedges. And the natural gas companies, a couple of years ago, some of them put on hedges around 4, but that was before their costs started rising. So those hedges were coming off, and then they were going to re-hedge their production at 5, 6, 7. Not every natural gas producer was able to do that, but you also have the scenario where the cost for the natural gas producer is up. So there are little to zero natural gas producers in the United States and Canada that can produce at 2 or 3. So if the natural gas futures contract, a lot of the cost structure for a lot of these natural gas producers is in the over 3 and 5 is in that range. So if natural gas prices do go lower, there's going to be or stay in this range for a while, there's going to be a buying opportunity. But I do suspect that the Chinese government is rebuilding their physical position, and they're going to start taking delivery of a lot of LNG tankers because they sold a lot of them to Europe. You can go and look up the story. You can go and look up, there's quite a few stories that were on oilprice.com back in October about this.
They're traders. The cost is down, so they're going to start buying. Basically.
Well, I think they realize, so they've done this before with my conversation with a retired Chinese banker, and he was explaining this to me, that if they think commodity prices run up too much too quickly, they will sell off certain physical, or they'll start shorting.
Mm-hmm.
And then they'll rebuy their position. So they're pretty sophisticated. They have commodities trading houses that are set up either through the Chinese government or through Chinese banks, and they will buy and sell and go short, and then they will rebuild the position. It's a little bit easier probably with oil tankers and natural gas tankers. I don't think the Chinese are selling any physical gold, but they might. I suspect they do it with other base metals and things like that, though, occasionally.
You know, on that note, we should talk about gold a little bit because it has ripped. I mean, I think back in September, I thought it bottomed, and that was when it was around 15, 16. It was about 1600 or somewhere. Now it's up to 1926. It's almost been a vertical climb from that point. I mean, it did test the bottom lows twice, but the past like month or so, it just ripped straight up.
There was a bunch of bears, Lee, that were arguing with me. Some of those bears were also claiming that Bitcoin was going to 150,000 or 200,000 by the end of 2022. I went and looked up their post history. So they were claiming they had a good track record of predictions, and their predictions weren't exactly good. Yeah, so they were claiming that Bitcoin was going to like 200,000 by the end of 2022. But they were saying that gold was going like to 1,400 or below, and silver was going to 10. And I was like,
no,
before we get to silver 10, I mean, the silver companies would be bankrupt. So,
of course,
we don't have the Q4 numbers out for the gold miners yet. So for Barrick and Newmont, I don't think we have the Q4 earnings call numbers out yet for their production costs, but the Q3 stuff that was out about 6 weeks ago for the Q3 numbers were ugly for how much the costs were up for Barrick and for Newmont, because they have these giant low grade open pit mines, and they're burning electricity and diesel 24/7, 365.
The trucks they use there probably get like a half a mile a gallon.
And on top of that, Lee, this is not high grade gold. So these are large scale earth moving trucks that they're moving mostly uneconomic rock, and it's barely 1 gram per ton gold.
Yeah, which is nothing.
It shows you how sad how much the grades are down, because back in the 1970s gold bull market, the gold grades were 20 or 30 grams per ton, and now that's super high grade. You're lucky if you can find a gold mine with that, like the Fruta del Norte mine in Ecuador, which just had an enormous exploration success. I think their average gold grades are I think they're around 15 grams per ton gold, super high, and they just had a really nice exploration success announced publicly in the last month or so, and that's considered super high grades. I mean, but back in the 1970s, though, that wouldn't be a high grade. So that wouldn't be a high grade gold mine. So now we're what's a high grade gold mine now is a lot different than in the past, but it just shows how much grades are down and how difficult it is to find an economic mine.
And Jason, think about that. In the 1970s, how much further ahead we are technologically, and how much easier it is for geologists to locate gold, and they can't find it. That's my.
Lee, they weren't even doing the type of open pit mining back then in the 70s. So they
didn't have to.
Well, also the technology wasn't available. So I think the technology became more widespread in the 90s and early 2000s. And that's when you saw Barrick and Newmont and like Freeport-McMoRan and some of the larger base metal miners start to do these large open pit heap leaching projects, massive ones with lower grade copper and gold and base metals and stuff like that. But that was for growth. So, I mean, in order to grow production, they've had to really the grades have been sacrificed. It shows like the depletion of the mines and the lack of quality that's available. And mining is a very difficult business. So if your costs are rising and there was a new study that just came out in the last couple of months. I didn't write an article up on it yet for patrons, because honestly, like my fingers are doing really, really bad. And I might need surgery on them soon. I've been going to see too many doctor specialists lately, unfortunately. I don't want to talk about my medical problems at length, but this is a sad reality. I don't really have use of 3 of my fingers right now. Anyway, though, the study just came out for the gold grades over the last 7 years. The gold grades at the average gold mine are down over 20%.
And that's significant. And that's once again in the face of a major increase in technology in the past 20 years, 30 years in finding gold. So
we're scraping the barrel.
That's my point.
Unless we're going to mine on the ocean floor where the grades are sky high, but the environmentalists won't allow it. So the grades on the ocean floor are sky high. They're not going to allow the mining though, because any company that's tried that hasn't gotten permits or they've gone bankrupt. So
I would imagine it's pretty cost prohibitive. It's not an easy process, I would think.
It's actually, if you have the right type of ship, it's actually cheaper than building a mine that's going to cost $5 billion or more out in the middle of nowhere where there's no power, no infrastructure.
Right,
it's actually cheaper than that.
That makes sense. So there is I was going to say, are we at a point where there's no more gold to get? But that's a big can of worms there with the.
No, there will always be gold, but in terms of being efficient and trying to find a higher grade and lower cost mine, I mean, those are going to be few and far between. So
Right.
what's a great mine? The definition of that's going to change. It's going to change a lot.
As
So
it has since the 70s, with your example that you just gave. I'm looking at the chart now on gold, and it looks a bit overextended. So I could see it pausing here, maybe coming back, testing around high 1800s or so, maybe finding a floor, and then maybe we're off to the races again. It'll be interesting to see. I think a lot depends on the dollar.
I
You
think
have any thoughts?
I think there's been games with the dollar index, Lee. So I think we are looking at a higher range for the dollar. I don't think the dollar is going to collapse. I think the Fed or the Treasury and or the US Treasury will step in if the dollar index gets too strong. So if the dollar index gets to like 118, 120, I think you're going to start to see the Fed and the Treasury panic that it's going to start collapsing European banks and hedge funds, family offices, insurance companies, pension funds, similar to what happened in England, a couple months ago.
So you're thinking central banks are going to force the dollar to stay weak?
Well, I think it's just the Fed and the Treasury. They realize, because the reports have come out, and I know they talk about this. The reports have come out about the numbers different. So we've seen different estimates. So there's between 65 trillion and 80 trillion. I don't even know if that's a real number of exotic or sophisticated dollar denominated debts in forwards and swaps, a good chunk of that. So you have at least, according to Brent Johnson of Santiago Capital, at least 17 to 20 trillion in the euro dollar market that European central banks created. That's the offshore dollar funding market they created without awareness from the Treasury and the Federal Reserve. So that started in the 50s and 60s. There's excellent video series from Jeffrey Snyder about that. Now, I don't agree with everything Jeffrey Snyder says. So his coverage of the euro dollar on that aspect is good. He just connects the euro dollar to everything. He claims that the euro dollar drives gold price and everything else. It's ridiculous. I mean, he's been wrong on a lot of his calls for a long time.
Yeah. Well,
but a large chunk of that dollar denominated debt is in the euro dollar market. So offshore dollar funding, because large corporations decided for cross-border trade settlement, it was easier rather than using smaller, less liquid currencies to just use dollars to settle global trade transactions in US dollars rather than other currencies. And then also, like, a lot of that dollar denominated debt, Lee, was in the Chinese banking system connected to their fake growth and their real estate bubble.
And we've seen a move internationally away from settling transactions in dollars, and I think that trend is going to continue. Would you agree?
It's slow. It's slow.
Yeah, of course.
I mean, it was 70% 15 years ago or 20 years ago. It was around 70% of all global trade was settled in dollars. I think it's down to 59%. Mm-hmm. You have experts all the time for the last 10, 15, 20 years saying the rate of change of trade settlement in dollars is going to fall fast. It has not fallen fast.
It has not accelerated at all.
As I've talked about on my YouTube channel for many, many years now with my dollar tug of war thesis, and we've talked about on our show here, Finance Unspun, almost every episode. Every time the dollar gets weak, you have short-sighted, myopic foreign governments and foreign corporations. They want to try to take advantage of this, and they take out even more dollar-denominated debt. This happened in 2021 when you had Peter Schiff and David Hunter were saying the dollar, that was it. The dollar is going to collapse. The dollar's topped. And then in 2021, Lee, you had over $400 billion of additional dollar-denominated debt taken out by foreign governments and foreign corporations.
And subsequently, we saw the dollar rally up to 112. This
is my point, though, Lee, with the dollar tug of war thesis and how the global financial system and global trade work right now is this thing as a cycle. So they weak dollar and they look at their own strong currency and higher interest rates in their local economy. And when the Fed had a easier monetary policy, they would say that, well, we're just going to borrow in dollars and hope that the dollar remains weak. But then when the Fed raises interest rates, then that's even more onerous and they get screwed. But then in the past, what the Fed has done is the Fed has stepped in and the Fed has done secret bailouts of foreign banks and foreign governments and foreign corporations. And there's no Fed audit to go through all the different types of bailouts over many, many trillions, by the way. We know at least 9 trillion went to the European Union and European Central Bank and large European banks for bailouts during 2008, 2009. And even more than that, in the 2019 repo crisis in 2020.
Mm-hmm.
I think what we're 26. No, it was 48 trillion, something like. There was some ridiculous number that required, because the derivatives exploded in 2019 and 2020, the last Fed rate hiking cycle. So we're going to see similar stuff, except this time, Lee, we're seeing with the news stories that the pension funds, the insurance companies, the reinsurance companies, the family offices like Archegos, and there were many others that were doing the exact same thing as Archegos. Archegos was the only one that was included in the headlines with Credit Suisse, that they all put on these stupid leverage hedge fund trades,
right,
because this central banks like the Fed had starved these pension funds from normal rates of return, say
absolutely,
with 5% on treasuries.
Yeah, I mean, basically, the Fed has created probably the biggest moral hazard in history over the past, 30, 40 years, as they've
100% agree. They've turned other central banks. Well, the Fed is not doing, to my knowledge, they're not doing all these crazy sophisticated hedge fund trades, although they're bailing out, it seems, a lot of entities that are, but they've turned these pension funds, these insurance companies, these reinsurance companies, these family offices, all, whack my water there accidentally.
You're right.
Yeah, I'm just angry here. They've turned all these entities that should be focusing on safer investments,
into hedge funds.
Desperate that were,
They've turned everyone into a hedge fund
because of zero interest rate policy for so long.
Yep, absolutely.
So the normal, sound, safer rates of return that they could have gotten from U.S. Treasuries in the past, and now we're at higher interest rates, but they're not sustainable though, because the U.S. is, it's just basic math, right? Because can the U.S. Treasury pay 5%? Can they afford to pay 5% or 6%? I even see people talking about 7% interest rates. I mean, the U.S. Treasury cannot afford trillions of dollars in interest payments on 7% rates.
I was going to say at 7%, it's like astronomical numbers there.
Lee, I'm not even sure they can afford 5% for that long.
I agree with you, but like what do you do? Because you're going to keep interest rates at 1% or close to zero forever. I mean, in perpetuity,
the system can't do it. The system is a fiat currency and credit Ponzi scheme.
Yep, absolutely.
The debt keeps growing.
Mm-hmm.
The government debt keeps growing. So we're going to have, I don't think it's going to be the U.S. first, but we're going to have a government bond debt crisis in the next couple years, probably 2 or 3 years. These central banks have raised interest rates, but they're all hitting a wall. When you have like the Bank of England raising interest rates, you have pension funds in England blowing up on hedge fund trades. And then you have all their counterparties with insurance companies and banks and all their other counterparties that loan them money. They're blowing up too. And then you have the Fed stepping in with secret bailouts for at least $600 billion. Otherwise, within a 24, 48-hour period, you would have had failures of pension funds, banks, and insurance companies in England. And this looks like the new normal, where it could potentially occur in many different countries.
Well, you also have a lot of private equity firms. I mean, they live by the leverage buyout, and interest rates play with that market probably more than almost any other market. It's going to be an interesting time if the rates keep going up.
Well, yeah, you're going to have a lot of companies and a lot of industries. Their cost of capital is much higher. They might not be able to get funding. Historically, in these types of environments, whether they're inflation or deflation, where you have rising interest rates, you have a lot of bankruptcies. And historically, inflation or deflation, where there's a lot of bankruptcies from a lot of companies and a lot of sectors, that's good for gold, because people are looking for a safety trade, for a safe haven. They're looking to reduce counterparty risk. That's normally good for gold demand and for cash like US dollars or for US treasuries. Although in this environment, maybe as a short-term trade, treasuries are okay. But I think long-term, I think the Fed wants to inflate the debt away.
Understandable. I mean, they don't have many options open to them, really.
I don't think they have any good options. They put themselves into a box because of so many years of zero interest. They inflated asset prices, but now if asset prices stay low, and the last thing we didn't cover yet is we haven't had this big real estate bust yet. We're seeing all these signs, Lee, and we've covered this on the show, of commercial real estate. of big red flags for commercial real estate, right? Well, we haven't had the big real estate bust yet, but if interest rates stay at these levels, we could have a big real estate bust, and that's going to collapse tax receipts, all different types of tax receipts at the local government level, state government level, federal government level here in the United States. And then the Fed, as the buyer of last resort of U.S. Treasuries, or maybe they do MMT and they just hand, because the Treasury can't print their own money anymore. The Fed does it. So the Fed would have to hand the Treasury money to go buy their own bonds.
As far as real estate, one thing I always look at is SL Green Realty Corp, because they're a big player in the commercial real estate in New York City. And I just look at their chart. I mean, it's just absolutely dismal. It almost looks like Bitcoin right now.
Well, it makes a lot of sense, Lee, because companies are, I mean, I just hear this all the time from my young adult friends. I mean, a lot of these companies expect us to work at least 20, 30%, sometimes even more than that, work from home now.
Oh, the world has changed so significantly.
Yeah. So, I mean, that makes sense. You need less commercial office space, right? So if you have more employees working more hours from home, you can do things digitally. I mean, like, you have to respond to emails. When you're working in a large company, you have to respond to emails all the time. So you don't have as much time off. You're working more time. I don't know if you're getting paid for it or not, but you're responding to emails late at night or early in the morning, and you're doing work from home.
Absolutely. When I started my career, I worked in Manhattan. I used to commute in by train, and you'd get into the Grand Central Penn, and it was just, you felt like
a rat race.
You felt like a cow in a herd of cattle, man. It was like so many people, and that's gone.
The trading floors. Yeah, if you go to the trading floor of the New York Stock Exchange, there's hardly any human beings, right? It's mostly computerized stuff.
No, it's all computerized. I mean, it's and even back in the internet bubble, you had trading floors where people would go and they would sit next to each other on a computer. Market makers would sit next to each other. You don't need that now. Everyone could do it from home if they wanted to. There's no need for commuting into the city. So that does not bode well for commercial real estate in the major cities. And I think that trend is not just in New York City. I think it's global.
I agree, but there will be opportunities. So there will be the opportunities, and for entrepreneurs, if there's cheaper prices, deflation is good.
Of course, yeah.
I know I know people in the government and the PhD economists and the Keynesians and a lot of hedge fund managers don't want to hear this, and they don't agree with this.
The control freaks. They're all control freaks.
Well, also a lot of them went to certain types of business schools, and they got certain types of economics degrees. And
absolutely,
they're like, deflation is bad. Deflation is good for consumers. As long as you don't have a lot of debt, deflation is good, because people will figure out, if you have cheaper computers, cheaper flat screen TVs, cheaper real estate, that will incentivize people to try to use the assets and the resources more efficiently.
Right. I could see a lot of commercial real estate being turned into habitational real estate and people moving in. Because what else are you going to do with that space in these major cities? There's just no need for the office space that was required 20, 30 years ago.
Yeah, or you have more competition, more innovation in new sectors. I don't know, new types. New York City has amazing innovation for restaurants. So,
yeah. So I know the restaurant business has been hurt in New York City over the past few years. So it would be nice to see it come back, because New York City has always been pretty famous for their restaurants. So is there anything else you wanted to cover tonight, Jason?
No, I think that's pretty much it. We're in a crazy type of environment. There's going to be a few more Fed rate hikes. It's just the nature of the beast, but it's getting close to the end here. I mean, the Fed's official balance sheet's bullshit. I don't trust it at all. I mean, some of the price action I see in some of the other markets and the bank stocks, there's definitely, with the dollar index and the Fed still raising rates, there's weird games that are going on behind the scenes. I don't know if we're ever going to find out, because they're not going to allow a Fed audit. I don't know if we're ever going to see any of the truth about any of the stuff that's happening. But
boy, that would be something if they did.
Well,
it really would.
Well, I mean, rationally, if you're thinking of it this way, with all the other problems and all these other economies and recession and all the slowdowns and bad earnings, I mean, Q4 earnings, Lee, we're going to have really bad Q4 earnings for a lot of reasons.
Mm-hmm.
The one reason I haven't heard a lot of people about with these higher interest rates, you're going to have with a lot of these large companies that have, when debt was cheaper, they loaded their balance sheet with debt. They did a lot of share buybacks. They didn't pay back the debt. And now with these higher interest rates, because they didn't pay back the debt and they didn't lock it in with their revolving credit facilities and their other use of debt, they're looking at much higher interest payments on their debt, these large corporations. So there could be dividend cuts and other problems. I mean, sales are going to fall. You're starting to see companies that would have never had to discount in the past that are announcing like sales. They need to clear inventory. They need to raise cash.
Well, that also means that we're looking at layoffs ahead, which is another impact on the economy. As people lose their jobs, they just spend a lot less.
Unless you have stagflation and supply chain issues. But with the data, you're seeing that people with higher rent, a lot of people 18 with the Federal Reserve Bank's own data, people ages 18 to 41 here in the United States, a lot of them, because rent was so high and their cost of living was so high, they had to move back in with their parents.
Yep.
So they're spending, since they're not spending on rent anymore or other types of bills, or the Biden canceled their student loan payments. Biden and Democrat Congress.
Yeah, they're buying more consumer crap.
Well, they were buying literally luxury brand items. So they're staying at home, living in their parents' house, and they were buying like designer purses and designer shoes and handbags and stuff like that. That's actually a trend, believe it or not. There's a lot of articles on this, and the retail experts are saying the trend's going to continue.
Well, if you can't live out on your own, I guess you have to comfort yourself with stuff. It's pretty sad. Anyway, well, Jason, good discussion again.
Yep. So a lot more volatility going forward. Surprisingly, the Fed rate hikes are not causing a dollar rally yet. But I think, like I said, there's definitely games going on in the currency market to prevent foreign banks and other entities from having problems in the derivative market with their bad trade, because we would be probably, if the dollar index was rallying, say at 115, 118, we would be looking at many more scenarios similar to what happened over the summer with the Bank of England and the pension funds in England and the insurance companies and all the connected counterparties that had on all of these bad trades connected to rising interest rates and a strong dollar outside the United States.
I think we could see a short-term rally in the dollar over the next couple of weeks, but I don't see any strong rallies that bring it back up to that level.
I think the new normal, unless they announce like some type of devaluation, is probably a higher dollar. So a higher dollar index compared to the past. I mean, the old dollar index trading range was from like 89 to 104 on the dollar index for about 8 years. So I think we're probably looking at a higher trading range going forward. A lot of it depends on if the Fed and the Treasury want to take a lot of pain and they want to do some type of rapid dollar devaluation scheme similar to what FDR did in 1934 with devaluing against gold. For now, I don't think we see that.
Do you think there's any possibility of that? Because we all know that they want to implement central bank digital currency here and Fed coin.
Yeah, there's a possibility of that. I mean, it's not going to happen though in the next 6 months or something. Yeah. It really depends if you start to see if Credit Suisse, if they can't do a reverse stock split successfully and sell billions of dollars of shares to sucker pension funds at a 10 or 15% discount to the market price. Well, that's how they kept Deutsche Bank alive for so many years. They were playing all these crazy games with Deutsche Bank. There was how many reverse stock splits, and then there was always like an equity sale to a pension fund at a 10% discount of market price. And these pension funds were stupidly buying the shares, even though I guess they just saw a discount to market price. They didn't even look and see that, they didn't even look and see like the balance sheet of Deutsche Bank or their derivatives position. That's what these pension fund managers are not the best and brightest.
No, definitely not.
They're normally the suckers at the table because they're getting hustled from high commission salespeople too. So when they do make investments, they're normally bad. And then when they do buy something else from like an investment bank, or they put money to work with a private equity or a hedge fund or a family office, they're getting suckered there too.
I wouldn't want to be one myself. So on that note, it was a great episode, I think, Jason.
I don't think you could be a pension fund manager, Lee, because you have a nice, clean resume and you don't have political connections. So you don't know the right people. Yeah. I mean, if you were doing coke with Hunter Biden and if you were like buying Hunter drugs, I think it would work out well for you if you wanted.
Yeah, I definitely don't know the right pimps or drug dealers.
Yeah, I think or you have to know like some of those honeypots that the Chinese Communist Party or other governments send out. Yeah.
There you go. All right, Jason, have a good week. We'll talk to you soon.
Great. And that was episode number 16 of Finance Unspun. I hope you enjoyed it.